founder opens a Cyprus company. The SaaS product is live. The first invoices go out. US client, German startup, French consumer, Ukrainian agency, Stripe payouts, EU VAT numbers, no VAT numbers. And then the founder says, but we sell online, we do not really sell in Cyprus. VAT should not be our problem. The sentence is usually where the problem starts. VAT is not asking where your website is hosted. It is asking who your customer is, where they are located, what you sell, and how the invoice is treated.
The first mistake is treating VAT as a company label. Founders ask, do Cyprus companies pay VAT? That is the wrong question. The better question is, what exact transaction are we talking about? A SaaS subscription to a German business is not the same as a subscription to a French consumer. A consulting service to a US company is not the same as an e-commerce sale to an EU private buyer, and a Cyprus company receiving services from abroad may have VAT obligations even when it did not charge VAT to the client. Start with the local baseline. Cyprus applies VAT to supplies of goods and services in Cyprus, acquisitions of goods from the EU, and imports into Cyprus. The standard VAT rate is 19%. VAT registration is generally compulsory when taxable turnover exceeds €15,600 over the previous 12 months, or is expected to exceed €15,600 within the next 30 days. But for online founders, the threshold is only the beginning. Intra-community services, reverse charge situations, and cross-border B2C sales can create obligations before the founder expects them. For many SaaS and service companies, most clients are businesses. In EU VAT logic, the general B2B rule for services is that the place of taxation is where the business customer is established. That is where reverse charge often appears. A Cyprus SaaS company invoicing a valid VAT-registered German business may not charge Cyprus VAT on that invoice, but that does not mean the transaction disappears. The invoice has to be issued correctly. The customer VAT number should be checked. The reverse charge wording should be clear, and the transaction still has to be reported properly. Reverse charge is not a shortcut, it is a documentation rule. B2C is where founders often get surprised. If you sell digital services, subscriptions, downloads, templates, online tools, or other electronically supplied services to European consumers, the customer's country can matter for VAT. This is the point many SaaS founders miss. We are incorporated in Cyprus does not automatically mean we only think about Cyprus VAT. For cross-border e-commerce and services in the EU, the one-stop shop can simplify reporting. A business can register in one member state and use OSS to declare and pay VAT on eligible cross-border supplies to EU consumers. The mistake is rarely aggressive tax planning. Most VAT problems are boring. The company does not separate B2B and B2C revenue. It does not collect enough customer location evidence. It treats all Stripe revenue as one category. It does not validate EU VAT numbers. It forgets that imported services may create reverse charge accounting. It does not prepare proper VAT reporting until the first accountant asks for it months later. That is how a clean company becomes operationally messy.
This is where regular accounting and tax support becomes more important than the incorporation itself. For a SaaS or online services company, the question is not only do we have a Cyprus company, the question is whether the company can issue the right invoices, separate B2B and B2C revenue, understand reverse charge, register where needed, use OSS where relevant, and keep enough evidence to defend its VAT treatment. At Icon.Partners, we help founders connect legal structure with the operational tax reality, company setup, VAT registration logic, invoice workflows, reporting coordination, and ongoing compliance support. A founder does not need to become a VAT specialist, but before issuing an invoice, the company should be able to answer 4 simple questions. Is the customer a business or a consumer? Where is the customer established or located? Is this SaaS, a digital service, agency work, goods, or something else? And what evidence do we have to support the VAT treatment? If the team cannot answer these 4 questions, the invoice should not be treated as routine. Cyprus can be a strong jurisdiction for SaaS, digital services, agency, and e-commerce founders. But VAT is where the structure meets daily operations. It is not enough to know the corporate tax rate. It is not enough to have a company certificate. And it is not enough to say we sell online. For VAT, every sale has a shape: customer type, customer location, type of supply, invoice wording, evidence, and reporting. Founders who understand this early build cleaner companies. Founders who ignore it usually discover VAT when the transactions are already messy.